So can you please save this link in your computer? So Saturday class is confirmed, right? No problem for Saturday class. Saturday class, you have a same link. The link I sent you last time. You have a same link for Saturday class. But for Tuesday class, this is your link. And I repeat again, Tuesday class is confirmed. But in any case, if I am busy on Tuesday, so we will not off. I will send to the office, and office will send you email. If his office do not send you any email, so obviously you have a class. All right. If office send you email, that means the class is canceled, and then I will teach you on Saturday. Right. Saturday is confirmed because I Saturday. All right. So now let's.
So teacher, there's no problem in Thursday, right? Like we have a class in Thursday. Okay.
I'm okay on Thursday, but I don't know you are busy or you are free.
No, like because we have a fixed schedule that every Thursday morning we have a class.
Not really morning because right now I'm not in Vietnam and morning time is not suit in my country here. So that means morning means night here. So I can't wake up 2 o'clock at nights to teach you. Okay, so now let's continue with. Kim Nian, Fan Kim Nian, I just received your assignment from office. So I will check and I will get back to you with your results. So now let's start with the practice question for your final accounts. And then we have 2 more sessions.
So last time we did the last activity 8.
Yes. All right. So we finish until activity 8, right? Until which activity we have done?
Yes, teacher.
Activity 8. All right. Activity 8. Student, and one more thing. Remember, in your last lecture, you will have a oral test, or the class test or oral test. You can say whatever you like. I will talk about this one maybe later, because we have 3 more classes left. So now let's start with the next topic. So that's um, all for your topic 5, final accounts or financial statements. Topic 5 is finished. Now we continue with our next topic. So next topic is about ratio analysis. Before we start with next topic, anybody has any question? If no question, then let's start with our next topic. And make sure you remember your final account information, because that type of question you most likely to see in your final assignment. So again, you do not have final exam. All right, you have only final assignment. You don't have exam. Same like as your midterm assignment. So you have a final assignment. All right. And yes, so let's continue. This is topic 6, right? Is that right? Yeah, okay. So this is your topic 6. And topic 6 is about your ratio analysis. Ratio analysis, right? Now, what is the ratio analysis? What is the meaning of ratio analysis? So in order to understand what is ratio analysis, we need to know why we prepare financial statement. Anybody tell me why we prepare financial statement?
So the company can monitor the firm performance of that years, and you can also give the financial information for the user to make the decisions.
That's mainly the main purpose, is that we provide financial information to the users, right? Now, idea is that we prepare financial statement for users. And what users do? Users use financial statement. All right. So users use financial statement. Use financial statement. Use it for decision making, right? You know that. But now the question is, how users use financial statement for a decision making. What they do, they simply look at the financial statement and make a decision? Of course not. So users analyze financial statement. What users do? Users analyze financial statement. Users, they analyze financial statement to make various types of decision. Doesn't matter which type of users you are. You may make investment decision or some other types of, maybe some other types of decisions. All right. So idea is that users, they analyze financial statement. Again, how can we analyze financial statement? How can we do that? You have different methods or different tools, different tools, different techniques, or whatever. Right? We have different methods, different tools to analyze financial statement. And one of the most common method is a ratio analysis. All right. So ratio analysis is one of the common method that we apply to analyze financial statement. So what is ratio? What is the meaning of ratio? Anybody knows? The sign of ratio is like this, but here we not specifically go with the sign here, but this is the sign of ratio, right? The two dots, right? So anybody knows what is the meaning of ratio? Why we use the ratio? Anybody, any idea what is the use of ratio? Like, as for example, male-female ratio.
So we can find the relationship between them, or the connect between number or something.
Yes, that is right. Ratio analysis is basically, ratio help us to comparison between two information, two datas or two numbers. All right. Ratio means comparison between comparison between two information. Comparison between two information. It's called ratio. With the help of ratio, we can compare two information, right? Two data or two numbers, two information. That's called the ratio. So that's what we're gonna do in this topic. We will learn about. So we will learn about how we use the ratio to analyze the financial statement of the company. How ratio analysis help us to analyze financial statement. I hope everybody understand what is the meaning of ratios. So in this topic, you have many formulas. All right, so you will learn about different types of formulas. All right. So let's continue with the next, all types of ratios. All right. So ratio analysis divided into 4 different types of ratios. Ratio analysis divided into 4 different types of ratios. First is a profitability ratio. Profitability ratio. Second one is the efficiency ratio. Third is the solvency ratio. And the fourth is a shareholder investment ratio. All right. So we have four different types of ratios. All right. And in each ratio, we have some other 3 or 4 types of ratios. So total, we have 15 or 16 types of ratios. So let's talk about profitability ratio. Now, what is profitability ratio? Profitability ratio is a ratio that helps us to know whether this company has an ability to make profit or not. Whether firm has ability to make profit or not. This company has an ability to make profit or not. This company can make profit or not. That is your profitability ratios. And this profitability ratio divided into 4 other parts, 3 or 4. First is a gross profit ratio. Second is a net profit ratio. Third is a, later I will explain you all these ratios one by one. This is your formula here. These are your formulas. This formula I will explain next slide. One by one we will study in very detail. Gross profit ratio, net profit ratio, return on capital employed ratio, and the fourth one is a return on equity ratio. All right. So we have 4 types of ratios here. So this is your profitability ratio. That ratio is your profitability. Efficiency ratio. Now, what is efficiency ratio? Efficiency ratio tells us about the utilization of asset. So let me write down, then I will explain you what is the meaning of utilization of asset. Utilization of asset, right? What does it mean, utilization of assets? We have to understand what does it mean. For example, you live far from your university. Your house is not really far, not really close to university. So you're living quite far. So every time you have to catch a bus to come to university. And you know that in morning time, buses are very crowded. And obviously we have a traffic jam in the morning. So that's why you cannot reach university on time. So always university late for your class. So teacher give you late. As a result, you lose your attendance, of course, but you also lose your lectures as well. So you're losing some information. So as a result, you get low marks in your subject. So now you ask your parents to buy a motorbike for you, and they bought a motorbike for you. So you can easily get university on time. But when they bought motorbike for you, and of course they bought a good motorbike for you, and you like that motorbike, right? But you like your motorbike so much, so you do not really ride motorbike so much, because you worry your motorbike will be dirty, your motorbike will be old. So that's why you're still not using motorbike, right? So you clean your motorbike all the time, but you do not ride so much because you worry it will be dirty, it will have scratches, someone will hit your motorbike, and blah blah blah, right? So that's why you're not using your motorbike so much, right? So now the question is, the money you have invested in your motorbike, do you think it's a good investment? I repeat, the money you have invested in your motorbike, do you think it's a good investment to invest in motorbike?
Yes, teacher.
No, it's not, because your parents spend $3,000 or $4,000 for your motorbike, and still you are not riding motorbike. Still you go to school by bus because you worry your motorbike will be old, your motorbike will be dirty, your motorbike has scratches. So you're not using your motorbike anymore. You're using less, but still you're going to school by bus and you do not reach your university on time. So this is not a good decision to purchase a motorbike. Instead of buying that motorbike, you can invest that money somewhere else. All right. So this is called the utilization of assets. You invest money in that asset and how often you are using that asset. Are you using frequently that asset to maximize your capacity, or sorry, you maximize your productivity or not? So that's really important to measure the efficiency. So utilization of assets is one of the common indicators to measure the efficiency of your asset. All right. Now, this asset this efficiency ratio divided into this efficiency ratio divided into further parts as turnover ratio. Second one is second one is accounts receivable collection period ratio. And the third one is accounts payable payment period. Accounts payable payment period ratio. All right. So you have three different types of efficiency ratio. Now let's move on to the next. Third is the solvency ratio. What does it mean, solvency ratio? Solvency ratio basically tells us the ability to pay debts, right? Okay. Now remember, there are two words that we use here. One is a solvency and insolvency. What does it mean? Anybody heard this word before? Anybody know these words, solvency, insolvency? You never heard these words? No? Okay, so I tell you if you never heard it. Insolvency means bankrupt. Bankrupt. Bankrupt means insolvent. Insolvency means bankrupt. Solvency means, okay, what does it mean, bankrupt? Anybody knows what is bankrupt?
So like you, when the company was not able to pay the money, to pay the debt. And
yes, and you don't have money to pay your bills. You are unable to pay debts. You have ability to pay debts. When company can pay its bills, like us, company survive, can company pay its bills? That's called solvency. All right. When company cannot pay its bill, company goes into bankruptcy. Bankruptcy. Now, next is a solvency. Now, what does it mean, solvency? Solvency means ability to pay debts. Ability to pay debts. That's called solvency ratio. Right. With the help of this solvency ratio, we can understand we can pay our debts or not. Now, this solvency ratio divided into other two parts. We have other two parts. Which two parts? This is called short-term solvency, short-term solvency ratio, and long-term solvency ratio. Short-term solvency and long-term solvency. Short-term solvency, you have a current ratio and you have a quick ratio. Long-term solvency ratios, we have gearing ratio, we have equity to total assets, equity to total asset, interest ratio. So we have three different types of ratios under your solvency ratio. All right. Current ratio, quick ratio, and gearing ratio, equity to total assets ratio, and finally, interest coverage ratio. So we have 5 different types of solvency ratios. Now let's move on to the 4th types of ratio, which is shareholders investment ratio. What this ratio about? Shareholder investment ratio helps shareholders to make investment decision. Helps to make an investment decision. Of shareholder investment ratios, different types of shareholders. So this shareholder investment ratio is only for shareholders. So this ratio may not be useful for other kinds of users. So its name is shareholders, right? So shareholder investment ratio. Now, this shareholder investment ratio also divided into some parts here. First is EPS ratio. First is EPS ratio. EPS ratio stands for earning per share. Second one is a price earning ratio. Ratio for a price earning, right? And the third types of ratio is dividend coverage ratio. And the 4 types of ratio, let me check. Okay. So the 4th types of ratio is dividend yield ratio. So we have 4 different types of shareholders investment ratios, right? So total we have 16 ratios. So you will study 16 formulas, right? And one more thing you have to remember here, when you calculate ratios, you calculate ratio for 1 year, this formula for 1 year, but every time in ratio analysis, you calculate ratio for 2 years. So you can easily compare these 2 years. Last year, you calculate ratios for last year, and you calculate ratio for this year, and then you compare it. All right? Every time, remember, you will calculate ratio for 2 years. I will explain you next. All right, so now let's start with the first ratio here. Start with the first ratio, which is gross profit ratio. We start with it. So what is the meaning of gross profit ratio, and what is the formula for gross profit ratio, and what this ratio tells us? So we will do 3 things, and in your assignment, remember, you also have to explain these 3 things in your assignment. So remember that. All right. Okay. So gross profit ratio. Gross profit ratio. What this gross profit ratio tells us? This gross profit ratio tells us about product profitability. It means whether the product has the ability to make profit or not. It tells us about ability. No, it's not ability to make profit. Gross profit ratio is about product profitability. Product is profitable to produce or not? Yes. Product profitability. Product profitability. Anybody remember how to calculate gross profit? Remember how to calculate gross profit?
So we have sale minus sale return, and we have the total net sales, and we also add some other income, and we minus with the cost of the goods sold, and we have a gross profit.
Yes. So in simple language, sales minus cost of goods sold. You don't have to say other income, this and that, but general idea is that your income, which is sales, so income minus cost of goods sold is your gross profit, right? So do you think if we have gross loss, do you think we can have net profit? if we have gross loss, can we have net profit? Yes or no?
No.
No chance. All right. If you don't have gross profit, how can you have net profit? Because gross profit, your number is already in minus, right? Your number have already negative. So how can that number be positive, right? So do you think if company has a gross loss, company should spend money on marketing and advertising to sell it? If company if product has a gross loss, do you think we should spend more money on marketing advertising?
I think no.
No, of course not, because as you are spending more and more money, your loss will be increased because you're already having a loss. If you spend more money, you have more loss because cost increase. As the result, your loss increase, right? So the idea is that with the help of gross profit ratio, we understand whether this product is profitable to produce. Remember, profitable to produce, not profitable to sell. Remember that. Gross profit is not about selling. Gross profit is about producing, because cost of goods sold, and cost of goods sold is about producing. Cost of goods sold is not about selling. All right. So if we having a gross loss, there is no reason to continue that product with some other kinds of cost, which is marketing, advertising, transportation, administration, and so on. That is your gross profit ratio. So now how can we calculate gross profit ratio? So we have a formula. We have a formula. The formula is gross profit divided by sales multiply by 100. Your answer will comes in percentage. All right. So as I explained you before, you will calculate this gross profit ratio for 2 years. All right. You calculate for 2 years. And for example, first year, your gross profit is 20%. All right. And second year, your gross profit is 30%. So first year, 20%, and second year is 30%. Now, what do you think? Is it good or is it bad?
I think it's bad.
It's bad. First year, your gross profit ratio is 20%. Second year, your gross profit ratio is 30%. So your gross profit ratio increase or decrease?
Increase.
Yeah, it's reasonably good.
It's good. Yes. So remember, if your gross profit ratio increase, good, decrease, bad. All right. So remember that. If this ratio increase, good, decrease is bad. All right. So this is your gross profit ratio about product profitability. So remember, you have to calculate for 2 years to understand increase or decrease. If you calculate only for 1 year, this is not good for you. That may not enough for you to estimate this is good or this is bad. All right. Now, second types of ratio is a net profit ratio. Net profit ratio. Net profit ratio tells us about overall profit.
Teacher,
Overall, yes.
I want why 1 year is not enough to have more information about gross profit.
Okay. I ask you one simple question. For example, you study first semester and then you study second semester, right? So you have results for 1 year, because 1 year we have 2 semesters. If you have a results only for 1 semester, let's say you got 70%, right? But you do not have result for second semester, can I calculate your performance? Can I understand your performance is increase or decrease from 1 year to second year, 1 semester to second semester? Now, if I want to know you good at study or not, what should I do to check whether you are studying good or not, whether you are improving or not? What I do, I simply compare the results of your subjects for 2 different semesters. Semester 1, how many percent? Semester 2, how many percent? And then I compare it. If your grades for first semester is 60, second semester 70, performance good. Grades first semester 80, second semester 75, performance bad. Compared to last semester, your performance is reduced. That's why we need 2 years information. Because 1 year gross profit, we do not know this gross profit good or bad. You need to know your performance of your company over the period of time so you can make a decision. You just have information about 1 year, you don't have any information about past. How can you understand this company good or this company bad? You need past information so we can compare it. Did you understand that? That's why we need 2 years. Same information, remember, same information for 2 years, same ratios, same gross profit for last year, this year, sales for last year, this year, and then we calculate gross profit ratio for 2 years, and then we have an answer. Is that okay?
Yes, it's okay.
Now, net profit ratio is overall profitability. So before I explain you overall profitability, I need to tell you something here so you can get an idea if you do not remember that. So remember, we have very important that I'm going to write down here. This is the same thing that I explained you before, but that's now much more in detail. So sales minus cost of goods sold is your gross profit, right? Minus non-manufacturing cost like it's marketing, advertising, blah, blah, blah. This is your operating, we call it operating profit. Operating profit. Minus interest expense, minus dividend, tax expense, and minus dividend for preference shareholders. So we got net income. Net income. So this net income means net profit. We can also call it net profit. That's the actual way to calculate net profit. So make sure you write down this income statement. You know that, but you go specifically with the particular name that I had using here. All right, because you may need this kinds of information here to estimate your net profit. All right, same thing here, the name that I have been using here. All right, sales. All right. You may not need this. You don't need that. But again, you need this number. It's important. Or you may need these numbers. Important. All right. So make sure you write down because this is important for you, right? All right. Now, what is the formula for net profit ratio? The formula is, here is the formula, is net income, remember net income, right, divided by sales, multiply by 100. So your answer will comes in percentage because we are using 100. So if this ratio increase, good, decrease, bad. All right, so this is your net profit ratio. So everybody okay with it? Yes or no?
Yes.
Now let's move on to the third types of ratio, which is return on capital employed. Return on capital employed. A return on capital employed means whatever money you have invested on company, whatever money you have, whatever capital you have invested, whatever capital you have invested, what is the profit on it? Return means profit. All right, so this is your return on capital because we invest money to make money, right? We invest capital. What is capital? Capital means equity plus debts. Equity plus debts. That is your capital. So whatever capital we have invested in a company, how much profit we are making on it. All right. So we have a formula. We have formula for return on capital employed. The formula is operating profit. Remember, operating profit divided by capital. Capital means this. That is your capital, right? Multiply by 100. Your answer will comes in percentage. If this increase, good. If this decrease, is bad. Right. So this is your return on capital employed. operating profit divided by capital, right? Now, next is a return on equity. Return on equity. Now, what does it mean, return on equity? Return on equity means whatever money invested by shareholders, whatever money invested by shareholder, how much is profit on it? Only about shareholders' money. This is total money here. This is your total capital. Shareholder plus from bank, total. But here is only about the shareholders. So whatever money invested by shareholders, how much is the return on it? How much is the return on it? So we have formula for it. So the formula is net income divided by equity multiplied by 100. So remember, all this information will be given in your question. Because in your question you have an income statement and balance sheet. So you can use this income statement and balance sheet to find all this information. Net income divided by equity multiplied by 100. So again, if it's increased, good. Decrease is bad. So everybody okay with it? So that is your profitability ratio. Any question or we move on? Any question or we move on?
Teacher, what is a formula of return on capital employed?
Operating profit divided by capital multiplied by 100.
Or
Operating profit. Remember I explained you before, operating profit. So that's all about your profitability ratio. So everybody okay with it? Profitability ratio? So now let's move on to the second types of ratio, which is efficiency ratio. Efficiency ratio. So in efficiency ratio, the first ratio is a assets turnover ratio. First types of ratio is assets turnover ratio. Again, this one tells us about the utilization of assets, whether we are using asset in a right way or not, right? It tells us about utilization, appropriate use of the assets, we can say that. Appropriate use of asset. So we have a formula. So the formula is sales divided by total assets. TA stands for total assets. So sales divided by total asset, and then of course you don't have to multiply any, and your answer will comes in times. How many times your sales is more than your total assets, so how much revenue we are generating using our assets. So if this one increase, good, decrease, bad, right? And I can give you one quick tip to understand. So always remember, if your question use the word, if the ratio is return, means in formula we will use profit. If ratio says turnover, that means we will use sales. So this is a quick tip to understand whether it's we have to use sales or we have to use the profit. So turnover means the overall, the profit. That's called the turnover, right? So this is your assets turnover ratio. Second ratio is account receivable collection period. Accounts receivable collection period. Now, what does it mean, account receivable collection period? Account receivable collection period ratio basically tells us how long account receivable will take to return money back to us. How long account receivable will take to give or return money, right? How long account receivable will take to give or return money. So that is your account receivable collection period. So we have a formula here. Formula is accounts receivable divided by sales. Actually, it's the credit sales, but sometime in the question you do not have credit sales, so just sales. Multiply by 365. We multiply 365, so your answer will comes in days. All right. If this ratio increase or decrease. Now, can you tell me if this ratio increase, is it good or is it bad?
I think this is bad.
It's bad. Why? Because your accounts receivable are taking
Long time.
period. Yes, they are taking longer period, and of course nobody likes that their account receivables are taking longer period to return money to us. All right, so that's why this ratio should be smaller, right? shorter period would be the better option for this account receivable collection period, right? Next, the third ratio. The third ratio is accounts payable payment period. Now, what this ratio says? This ratio says right. So this ratio says how long you will take, because you purchase money from accounts receivables. You purchase material from account receivables. So of course, you have to return money to accounts payable. So how long you will take to return money to accounts payable? So this is accounts payable payment period, right? So we have a formula. Formula is accounts payable divided by credit purchase, right? Check in your question, do you have credit purchase material or not? So credit purchase. But sometime in question, there is no credit purchase. So you can use cost of goods sold, because cost of goods sold involve the material, purchase material. So you can use cost of goods sold. But check first whether do you have credit purchase in your question or not. All right. So then you multiply by 365. So high or low. Same like as account receivable collection period, if this ratio is high, is bad, low is good. Why? Because, for example, your accounts payable, they gave you 15 days to return money back to you, but you are taking longer period, longer than 15 days. So means they will not receive money on time. So do you think they will be happy about it? Of course not, because you are not paying them money on time. Same like as you, if someone do not return money to you, right? If someone do not return money to you on time, you're not going to be happy. Same thing when you do not return money to someone on time, then someone else may not be happy. All right. So that's why this ratio should be shorter period. So your efficiency ratio is finished. So we have three types of ratios: assets turnover ratio, accounts receivable collection period, and accounts payable payment period. right? Any question or we move on? Let's move on.
Sure. Can I have a question? I'm not sure about why we return money to account payable longer is not good for is that
Same example, same example I gave you. For example, you are my accounts payable, and I agree to pay you money. We sign a contract that I will return money to you in 3 weeks, in 21 days. So you are waiting money to receive that money in 21 days. But I am taking more than 21 days. So do you think that will make you happy? No. So what? If you are not happy, so what? How it will affect me? If you are not happy, next time when I will come to you to purchase raw material on credit, do you think you will give me material on credit? Of course not, because you remember that last time I did not pay money back to you on time. So next time when I go to you to purchase material, you will not sell material on credit, because you said you never return money to me on time. You're supposed to return money to me on time. So that's why longer period is not good for you for future. That makes account payable unhappy.
So it's accounts payable payment period. Does it affect on our profit?
Accounts payable payments period, that's may not affect on your profit, but it may affect on your cash system, cash in and cash out system, right? Like for example, if you do not return money back to accounts payable on time, you're taking longer period. So next time you don't have cash, but you want to purchase material, so you cannot. So you have to borrow money from bank to purchase raw material, because your accounts payable is not agreed to give you material without any cash. So that could be effect of this payment period on your cash in and cash out system.
So when we purchase on credit, do we have interest?
No, interest is when you borrow money from bank, or when you deposit money in bank, then you receive interest. It has nothing to do with interest. You don't have to pay extra money. That's in accounts payable. You don't need to pay extra money. I purchase material from you $5,000. I will return to you $5,000 after 2 or 3 months. That's it. No interest. Interest is when you borrow money from bank. Then we use the word interest, but here you don't have to pay any interest. Right. All right, so now let's move on to the next. The third type of ratio is a solvency ratio. All right. So now the third ratio is a solvency ratio. In solvency ratio, the first ratio is short-term solvency ratio. Short-term solvency ratio. Short-term solvency ratio means how long you take to return money in a shorter period of time, or how long you take to return your short-term bills. That's the meaning of short-term solvency ratio. Your bills in your short period of time. So the first ratio is a current ratio. Current ratio. Current ratio is basically comparison your current asset with your current liability. Means, do we have enough current assets to pay for current liability or not? Because current asset means the assets you can convert in a short period of time, convert into cash. And current liability means the liability you have to pay in short period of time. So you're going to compare your current asset with your current liability. Right? So do we have enough assets, enough current assets to pay current liability? So we have a formula. Formula is current asset divided by current liability, right? Current asset divided by current liability. So now this ratio, of course, this ratio should be high. Obviously, your current asset should be higher than current liability. But this ratio should not be too high. All right. High good, high good, but not too high. High is good, but not too high. So what should be the perfect ratio? So the perfect ratio is if your ratio close to 2:1. What does it mean 2:1? 2 means current asset and 1 means current liability. It means for every one current liability, 2 current asset. Right? For every one current liability, we have 2 current asset. In simple language, for every $1 liability, we have $2 current asset. So we can easily pay. So that's the meaning of 2:1. So your answer is always comes in a ratio. Ratio means, for example, your current asset is 18 and current liability is 6. So your answer is not 3. Your answer is 3:1. For every $1 current liability, you have $3 assets. That's the meaning of this. So 2:1 is the perfect ratio. But again, 2:1 or 3:1 is fine. But if your current asset is 5:1, 10:1, it's too high, which is not good. Why? Why is not good? Anybody can tell me? If your current asset is too high, why it's not good? Anybody has any idea? Why too high is not good? Because current asset means the money you can convert into cash, right? So means you do not invest that money for a longer period of time. So can you tell me, in simple language, you can say that current asset means holding a cash. Do you think holding cash is better option or investing cash better option if you do need cash? Tell me. Holding cash is a better option or investing cash is a better option?
Invest.
Investing cash, obviously. Let's understand in another way. For example, can you tell me, let's say you do not live with your parents, you live in another city because you are studying, you're renting a room, and your parents send you money every day, every month, every 6 months. So can you tell me, on an average, how much money do you spend if you go to university? Nowadays you stay at home, but for example, if you go to university on daily basis, how much money do you spend? 50,000, 100,000, 200,000? Just give me an idea. On an average basis, how much money you need every day? Not rent, because rent you pay one time. I'm asking about your petrol, your food, your drinks, tickets to travel, go by bus or go by Seom or taxi, whatever. Just on an average, how much money do you spend every day? 100,000?
About that, about 100,000.
Okay. So for example, your parents send you $1,000 for every month, right? They give you cash, $1,000 to pay your rents and everything. Now, you have two options. Option one, you keep $1,000 in your pocket all the time because you need money, you can pay your bills. Second option is, in your pocket, you put 200,000 or 300,000 Vietnam dong every day. That's it. And the rest of money you deposit in your bank, so bank will give you interest. So which option is better? You keep $1,000 in your pocket, or second option is you keep 200,000 or 300,000 Vietnam dong in your pocket every day, and the rest of money you deposit in your bank. Option one or option two?
Option 2 is better, teacher.
Option two is better, because holding too much cash is not a good idea. You can lose money, not only about company, you don't lose money, you drop money, but you can invest that money is a better option. That's why if this ratio is too high, we simply losing opportunity to invest that cash if you hold in cash. All right, so that's why this ratio should not be too high. Double is enough. Like as every day you spend 100,000 Vietnam dong, you just keep 200,000 Vietnam dong in your pocket. That enough. Yes, you keep it double, right? Because you know that every day you spend 100, so you just keep 200. You don't have to keep 20 million or 30 million Vietnam dong in your pocket every day. You don't need that, right? So this is called a current ratio. So obviously this ratio high is good, but not too high. Remember, do not keep it too high. 3:1 is enough. 2:1 is perfect. 3:1 is okay, but 4:1, 5:1, 10:1, 20:1 is too high. So don't keep it too high, right? So that is your current ratio. Now let's move on to the second ratio, second short-term solvency ratio. Second short-term solvency ratio is a quick ratio. Quick ratio. Now there is a problem with this current ratio. What is the problem with current ratio? In current ratio, we do not understand how much cash do we have, because what inside current assets? Current assets, we have cash, we have account receivable, we have closing inventory, and we have prepaid expense. Right? These are part of your current asset. But this current ratio, if current asset is high, now what does it mean? What is high? If cash is high, this is good. If account receivable high, that's maybe good because you can ask to give that money back and your cash increase. But if your closing inventory high, that's may not good. And same if your prepaid expense is high, that's may not good too, because these two things not easy to convert into cash. So for example, your current liability is $6, right? And your cash is $1. Account receivable is $3. Closing inventory is $6. And this one is 10 plus 8. Prepaid expense is $8. So how much is your current asset? Current asset is 18. So current ratio is 3:1. You said, oh, you will say that is good. Yes, current ratio is good, but look in this 18, actually our cash is only $4. The money that we need to convert, when we need to convert into cash, we can easily get this one, but this and this, this one cannot get it back because you already paid it. How can you get your prepaid rent back? Nobody pay your rent back. Same thing happened with your closing inventory. So this is the problem with your current ratio. So that's a solution for this problem. Everybody understand the problem here? Yes or no?
Yes.
Okay. Now, so what is the solution of this current ratio problem? Solution is a quick ratio. Quick ratio. Quick ratio means quick convert into cash. We focus only on those assets that we can quickly convert into cash. Quickly convert into cash. So what is the formula? The formula is current assets minus closing inventory minus let's keep it simple. Closing inventory, current assets minus closing inventory minus prepaid expense divided by current liability. All right. And this ratio should not be too high. So the perfect is 1:1. Something close to 1:1. I think that is okay, right? So everybody understand the quick ratio? Can we move on to the next? So that's all about your short-term solvency ratio. Now let's talk about the long-term solvency ratio. Long-term solvency ratio, the first ratio is a gearing ratio. Gearing ratio basically tells us how much debts we have in total equity. How much debts in total capital, not total equity, total capital. In our total capital, how much debts do we have, right? So that is your gearing ratio. So we have a formula for gearing ratio. So total debts divided by total debts plus equity. This means capital. This is your capital, right? Multiply by 100 and your answer will comes in percentage. If this ratio is high, good, or low, good? Tell me, this ratio high is good or low is good? Quickly, tell me, high is good or low is good?
I think high is good.
High is good. Everybody, high is good? Low is good. Why high is good? High is good, what does it mean? High is good means in your total capital, most of money comes from debts. That's the meaning of high gearing ratio, because debts divided by total debts plus equity. So means in your capital, how many percent are debts? If debts are high, so means you are borrowing too much money from the outsiders. So your liability increase, your debts increase, your liability, your debts increase. So there is a high possibility that that your ability to pay debts may be affected, or your business may face some kinds of financial difficulties in future, right? So remember that this high is not good, low is good, right? Next is equity to total asset ratio. Equity to total assets ratio. Equity to total asset ratio means how much equity we have in total capital. How much equity we have in total capital. All right. So we have a formula here. So formula exactly opposite of this. So it means here debts, here we use equity. So equity total debts plus equity, right, is equals to 1%. So it should be, answer will be in percentage. So should be high or low? Anybody? So this should be
High.
high. Yes. So obviously if equity is high, debts is low. If debts are high, equity low. So it should be higher. Good. It's bad. So this is your equity to total asset ratio. All right. Now next, the third types of long-term solvency ratio is interest coverage ratio. Interest coverage ratio. Now, you know that interest is your long-term liability, fixed liability, you can say. So means we have to earn enough profit to cover the interest. Otherwise, bank, if you don't return back, take over the assets, bank will sell the asset and recover the money. So that's why we have to generate enough profit to cover our interest. Do we have enough profit to cover interest or not? Do we have enough profit to cover interest or not? So that is your ratio. So we have a formula here. Formula is operating profit divided by interest expense. 3 times, 4 times. So this ratio should be high or low. High is good or low is good?
High is good, teacher.
Better, yes. High is good, low is bad. High is good means you have more profit to cover your interest expense, and which is good for you, right? Everybody okay? So now let's move on to, everybody finish? Can we move on to next? All right. So now let's move on to next, the last ratio. The last ratio is a shareholder investment ratio. Shareholder investment ratio. So in shareholder investment ratio, the first ratio we have EPS. EPS stands for earning per share. Earning per share. Earning per share means how much money you earn on one share if you hold it. So how much earn on one share? If you're holding a one share, how much money you will earn on one share, right? So we have a formula. Formula is net income divided by number of It's common shares, not total share, common share. It will be given in your balance sheet when you have a question, right? So number of common share. Number of common shares. And your answer will in dollar per share. Your answer will be in dollar per share, right? So let's say your net profit is $1,000, right? And you company issue 100 shares in a market. 100 shares in market. So it means how much money you earn? You will earn $10 per share. So this is your EPS. If company profit is 1,000, you earn $10 one share. If you are holding 5 shares, you earn $50. But you don't have to go with $50, but just $10 per share. Right? Better or low better? High good, low bad. Why high good? Because you earn more money. Simple. This is high, this is low, you are earning less money. All right. So this ratio should be high. Second types of ratio. Price earning ratio. Price earning ratio. Price earning ratio basically tells us between holding share or selling share, because if you hold share, you receive dividend, and if you sell share, you receive profit, income, right? So in this ratio, comparison between holding share, if you hold share, you have EPS, right? If you hold share, you have EPS, you earn per share. And holding share and selling share. If you sell share, you have market price. So you're simply comparison between earning per share and market price. So we have formula. Formula is EPS, earning per share, divided by market price per share. All right. Your answer will comes in times. And high is good. High is good. Low is bad. All right. So this is your price earning.
Teacher,
Yes.
can you explain me again the times? What does it mean, the times?
Or no, wait, there's something wrong with this formula. Something wrong. I think market price. Wait. I think it should be market price divided by EP. Sorry, I used the wrong numerator and denominator. The formula should be market price per share, market price per share divided by earning per share. So how many times your market price is higher than your EPS? If market price is more higher than EPS, so means the value of share is so high. All right, so the value of share is so high is good for a company. All right, so this ratio should be higher. Is that okay?
Okay.
Now let's move on to the third types of ratio, which is dividend cover ratio. Dividend cover ratio. Again, are we making enough profit to cover dividend or not? Same like as interest cover. Are we making enough profit to cover dividend or not? So formula is EPS is a profit, right? It's profit divided by DPS. EPS means earning per share, DPS means dividend per share. So how much company earn profit to cover the dividend that company promised to pay to their shareholders, right? And your answer will comes in times. Higher, good, lower, bad. All right. Is that okay, everybody? If it's okay, then let's move on to the last ratio, dividend yield ratio. Dividend yield ratio. Dividend yield ratio means how much dividend, how many percent dividend shareholders receive. How many percent of dividend, how many percent of dividend, how many percent shareholders receive as dividend, right? So for example, company share price is $20 and company dividend pay $1 per share. So how much dividend company earn? So formula is, we can say dividend per share, here same DPS, dividend per share divided by market price per share. Market price per share. In simple language, like as for example, company is paying you $1 dividend and the market price is $20. So how many percent dividend you are earning? Right? You are earning 5%. So 5% you earn as a dividend. Company pay you 5% of its market price. So your answer, you can multiply by 100. Your answer comes in percentage. You can say percentage, or maybe, yes, percentage, because you're earning how many percent. So high, good, low, bad. So that's all for your dividend yield ratio. So shareholder investment ratio is finished. So all information will be given in your question. So next lecture, when you will come to the class, maybe next Tuesday, hopefully, then we will do some practice question. But right now, I'm not giving you any kinds of homework, but I suggest you, please try, if you have no calculation for your homework, so I can give you another homework, is try to remember all these formulas. Remember all the formulas, because in your last lecture, you have a class test or oral test. So in oral test, I can ask you any question, especially theory questions or formulas question. All right, so I suggest you to focus on understanding the question. All right, so everybody okay now? Any question? Any question, anybody? No question. If no question, then we stop here. Now I will see you next week, Tuesday, hopefully. If I do not send you, or office do not send you any email, so that means we have a class. If office will send you email, so then maybe cancel. All right. Okay, so we stop here. If you have any question, please send me email. All right, so now I will see you next week, Tuesday afternoon. All right. Thank you very much. So remember, we will start class, if I'm teaching you afternoon, so we will start class at 1:30, not 1 o'clock. All right, 1:30, like as today we started 1:30, not 1 o'clock. All right. So we stop here now. I'll see you on Tuesday. Thank you. Bye-bye.